Failing to research the market thoroughly. Entering the real estate world without thorough market research is like sailing without a compass. Many new investors get caught up in the excitement of buying property and overlook the critical details about the area, market trends, and local demand. Understanding these factors can make or break your investment. Picture this. You buy a rental property in what seems to be a booming neighborhood, but after closing the deal, you find out rental demand is low and property values are declining. This happens because market research wasn't prioritized. Key aspects like job growth, crime rates, and school quality can heavily influence property performance. Always start by analyzing the neighborhood's growth potential and how it aligns with your investment goals. Additionally, keeping tabs on market cycles is essential. Real estate markets are cyclical, and timing your purchase during a downturn can help you secure properties at lower prices. Conversely, buying during a peak might mean overpaying and waiting years for returns. Look beyond flashy listings and focus on solid data, consulting reports, and speaking with local experts to get a comprehensive understanding of your target market. Finally, technology can be your best ally. Online tools and resources, such as heat maps for rental demand and predictive analytics for market trends, can provide insights that were once only available to seasoned pros. Combine this with in-person visits to neighborhoods to observe traffic, infrastructure, and amenities. Doing your homework thoroughly will ensure you're setting yourself up for a profitable investment rather than a risky gamble.